Hey guys, I'm back. How you guys doing? I'm sorry we had a bit of a hiatus last week. I've been quite swamped with work lately. As you might know, it's RSP season. The deadline to contribute to your RSP is March 1st for tax year 2020. So I've been busy helping clients open up their accounts, sorting out their investments, and writing in insurance. Oh my god, it's just like one thing after another. People, if you need to get your RSP sorted out, do not wait for the last minute, please. Sometimes technology just fails, okay? If you haven't watched my RSP video, click up here. Welcome back to another episode of Money Talk with Hermy! I am your show host, Herman, but everyone here calls me Hermy. If you're new to my channel, welcome. I talk about finance, I talk about investments, I talk about insurance, basically every little thing about finance I talk about. So sit back, relax, and enjoy the show. This week's topic is going to be about mutual funds. Last week I was talking about what an ETF is. If you haven't watched it, click over here and give it a quick watch. I mentioned some mutual fund references inside the video, so there was a few people who DM'd me on my Instagram, so I'm just going to give you guys a quick primer on what a mutual fund is. Without further ado, let's get started. So what exactly is a mutual fund? A mutual fund is an investment vehicle that is made up of a pool of money collected by many different types of investors. You actually may have already been investing in a mutual fund. Usually when investors start out in their journey, they go to their banks or their credit unions. Then naturally, they sell these types of products there, and it is most commonly sold by the bank. Every mutual fund will have a fund manager who will then take the money that is collected from the different investors and invest it on their behalf. Inside the fund, it can hold things like commodities, bonds, or different types of assets. Each fund has a set type of objective, and the fund manager must abide by it. So if a mutual fund is geared towards retired individuals, the objective of that goal is to generate income, and that it needs to be safe and conservative and avoid market downturns or the fluctuations of the market. You own the assets through the fund. So for instance, if the mutual fund holds companies like Apple, you own shares through the fund, but that's dependent on how many shares of the fund you own. So generally speaking, there are three basic structures of a mutual fund. The first one is called an open-ended mutual fund. What that means is that they sell their shares of the fund every day. Then the next one, we have something called a close-ended mutual fund, and that means the shares of the fund is issued to the public once, and that's it. Then after that, the fund is listed on the stock exchange. Then the investors can change amongst themselves. So it goes from one investor to the other. You cannot sell the shares of the fund back to the fund itself, but you can get rid of them by by selling it back to another investor who may want to purchase it. Then for the final one, it's not that common. It's called unit investment trust. So same thing as the closed-ended mutual fund. It is only offered to the public once, and after that, that's it, that's all. You can, however, sell your shares of the fund back to the fund itself. It's not listed on the exchange, and you can't sell it to someone else, but you can sell it back to the fund. And for these types of trusts, there are no fund managers. So the assets in there doesn't change. So say the trust itself owns several different companies, then that's all that the trust will own. Okay, so now you've decided that you want to invest in a mutual fund. How do you go about investing in a mutual fund? Well, it's easy. You have a bank account, right? Said bank will probably offer you mutual funds. You could go to your credit union, brokers, or generally speaking, any financial institution very likely to have their own in-house mutual fund. There are required minimums to invest in a mutual fund though. So some funds might require you to invest at least $50 per transaction, some might be $100, etc., etc. Mutual funds trade only once per day, which means that the price of the mutual fund per share is settled at the end when the market closes. So why bother investing in a mutual fund then? It offers you diversification. I used this term in my previous ETF video. Basically, it means that you're not putting all your eggs in one basket. So you spread your risk, so your eggs, in many different types of baskets. So in case one falls or fails, then it doesn't affect your overall portfolio as much, as some may do better than others, so it balances it out. You know that your investments have a professional fund manager making decisions on your behalf. Because the mutual fund is a vehicle that has collected multiple different investors' money pulled together, you have a lot more buying power. Say like if you really wanted to buy an individual stock, like Google or like Alphabet or something, like it's really expensive to buy one stock, but say now that this fund holds Google, then it doesn't cost that much money to invest. Instead of paying like a couple $100 per share, you could just put in $50 and you will own a small portion of Google. So you might be wondering what type of mutual funds are available. There are thousands of mutual fund products out there. As there are thousands of ETFs out there, there are lots of mutual funds to choose from. There could be anything that be tracking the market index. There could be stuff that is only for certain themes, like invest in green stocks. There's just like anything you can think of, like they have it. So currently, the mutual fund market in Canada is valued at $1.5 trillion. That's a lot of zeros. Whereas, say, compared to an ETF market, they only have a measly $170 billion worth of assets. Mutual funds have been around a bit longer than ETFs though. They've been around since the early 90s, if not earlier. But that's when the whole boom really kind of happened. So mutual funds have something called an MER. This is the management expense ratio. This is to upkeep the fund, to pay the fund managers, any management fees, administrative fees, any buy-sell commission fees that are paid to the brokers. All funds have an MER. My gripe with mutual fund is that their fees are very high compared to, say, an ETF. All funds will have an MER regardless. You can't get away from it, okay? Someone's got to make their living, so you're going to have to pay up if you want to invest in the market. One of the problems with investing in mutual fund is that they're, generally speaking, the returns aren't very good. Like, we're talking about averaging between 2 to 4% after fees. So, you know, like you could buy into different products and do other types of investments that will give you a slightly above average return, like 5 to 7% perhaps. But the banks have been around for so long, I don't know why they don't offer the better mutual funds to their clients. Of course, you know, not all funds are created equal. There are, like I said earlier, there are thousands of funds out there. So you, as the investor, you have to do your own homework. You have to look at returns, look at the holdings, and look at all the various different aspects of investing in a mutual fund and what makes sense for you. Another big problem with investing in a mutual fund is that, generally speaking, it's always the same recycled mutual fund, but just wrapped differently. The top 10 holdings of a mutual fund is basically like the top 10 companies that the fund is investing in. You go to Bank A and you wanted to invest in a mutual fund. They might give you various different products to choose from, all in-house of course, but their top 10 holdings are very similar. In that case, are you truly diversified, meaning your risk is spread across several different sectors and asset classes, or really you're just buying the same product but wrapped up differently? I don't know. For me, mutual funds, they don't make sense. It is very expensive. Generally speaking, the returns are dismal. I highly recommend you, as the everyday investor, to go do your own homework. But of course, if you don't know where to start, I think mutual funds is a great place for you to park your money in the meantime. But in the long run, I don't think it's a great place for you to put your money. There are other different types of investments out there, and there are other ways to make money. So that's it, guys. That was my overview on what a mutual fund is. If you found this video helpful, please go down there and smash that like button. And don't forget to click on the subscribe button so it lets YouTube know that the channel is growing and that it lets me know that I'm doing something right with my life. So if you have any questions about mutual funds, by all means go down there and leave me a little comment. If you want to ask a more specific question and you don't want the whole world to know, my email is in the description box, so you can feel free to shoot me an email over there. Otherwise, I will see you guys next time on Money Talk with Hermie. Bye bye.